We now have a fantastic panel of speakers to reflect on the videos you have just viewed and to provide their own expert opinions on multilateral and unilateral approaches to taxing international taxpayers. To begin, I would like to introduce the three speakers we have on the session today. Firstly, there's Carmel Peters, who is the Policy Manager at Inland Revenue, New Zealand. Second, we have Liselott Kana, who's the Head of International Taxation at the Finance Ministry of Chile. And we have Brian J. Arnold, the Emeritus Professor of Tax Law and Senior Advisor at the Canadian Tax Foundation. To start, each panelist will be doing a short presentation on today's session topic. So firstly, I would like to welcome Carmel Peters to share her views.
Okay, greetings from New Zealand. We have our election actually coming up in the next 24 hours, so it's an interesting time in our country. I just wanted to do a little bit of scene setting, and maybe for some of you this will be, pretty obvious to you, but I think it's good to start from the beginning. The issue with digital taxation has been front and centre of international tax policy controversy and debate since the beginning of the BEPS project. So it's not a new subject, and to be honest with you, opinions vary as to whether there really is a problem at all and what that problem is. But let's just move on and just look at the treaty perspective. We take as a given that bilateral tax treaties are largely based on either the OECD or the UN models, which have a lot of similarity in any event. So for both of them, a market or source country can only tax business profits where there's a taxable presence in the country, being a subsidiary or a permanent establishment. And frankly, that historically has worked well, because to administer a tax system, you do need a place to go and actually collect the tax, and that has been the way that the system has worked in the past. So why do we have a problem? Well, put bluntly, modern business practices and digitalisation mean that an enterprise can be significantly involved in the economic life of a country while being subject to very little tax on its business profits. And why is that? Three factors: scale without mass. They can transact over the internet so that they don't have a place of business in country and perform taxable activities. And even if they do have an office in country, it's probably going to be a pretty small operation. There's user value creation. The digital firms build up their value by increasing their user base in country, and they get the valuable data from the users and develop the valuable networks. So for instance, a digital firm with 1,000 users is a lot more valuable than a digital firm with one user. And finally, there are intangible assets. Digital firms and other firms are heavily branded and give rise to valuable intangible property, which is hard to value in mobile. So this is a huge development for governments to deal with. And if anything, the COVID experience is just puts a spotlight on it, because we're all relying on digital firms to deliver the ability to connect like we are doing tonight or today, wherever you are in the world. It's fair to say it's not limited to digital firms. Non-digital firms with heavily branded products can also present the same sort of problems, and this is why it's being looked at as part of the OECD package. It's a very confronting issue for international tax settings as we know them, and it's a very difficult issue for governments to grapple with. I want to give time for other people to speak, so I'm going to be very brief. I'm a bit of a CNN addict, and in the words of CNN, we have breaking news. As you will have heard from Pascal, the OECD's inclusive framework released its blueprint on Pillar 1 and Pillar 2. And these tackle the twin issues of the issue that I've just been talking about, scale without mass, and also, on the other hand, the issue of minimum tax rates, which is more of a BEPS issue, to be honest. So they have released these two documents. They are a rich source of material to read. There are many issues that remain open, but the OECD has put together the building blocks for a multilateral solution to these problems. So, and I think, to give them a great deal of credit, there's been a lot of effort to try and pull out what would need to be done to resolve these issues. But then there's more breaking news. On October the 14th, the UN Tax Committee released an updated version of a draft treaty article which would allow countries to tax payments for digital services at a low rate. So that just came out this week. The sort of rate that's there's no rate set in the model provision, but the rate that's sort of contemplated is something between 3 and 4%. And of course, the treaty would provide that it was relieved under Article 23, so exemption or credit method. With that, I'm going to now let my other co-panelists make their contributions. Thank you very much, Anjana.
Thank you, Carmel. So next, I would like to welcome Liselott Kana to share her presentation.
Thank you, Anjana, and greetings from Santiago, Chile. Great to be with you all. You've heard the introduction by Carmel, and the OECD has presented a proposal on this Monday, and the UN has presented a proposal this Wednesday. So we are very, very much, in the spotlight and very, in a very interesting period. To build a consensus with all the different types of economies participating in the inclusive framework, which is the organ that the OECD is working with, the OECD Secretariat is working with the inclusive framework where we have more than 130 jurisdictions participating. The meeting before releasing the blue papers or blueprint papers on Monday, the meeting before that on Thursday, Friday last week was participating 450 officials from 130 countries, diverging from countries like the US to the Kingdom of Eswatini, which perhaps some of you who hasn't studied geography lately, but that is actually Swaziland. It's called Swaziland when I studied. So you can imagine the range of economies that has to come together, trying to come together to get a proposal. It is extremely challenging. So what was released on Monday? Well, they will release two pillars. The pillar one deals with how to tax large multinational groups that generate profits in a jurisdiction where they do not have a taxable presence, as Carmel mentioned, under current international tax rules. So what we're dealing here with Pillar 1 is a new taxing right. It's something that doesn't exist today, a new taxing right. And secondly, that new taxing right is defining how to assign those profits of this entity that is not taxable present in the jurisdiction. There's so there's a new taxation and there's new pricing, transfer pricing rules. The OECD Secretariat put forward a plan, I think about a year ago, for this Pillar 1 that fused various proposals from different countries. And of course, the risk with that is that no one is really happy. But perhaps that is the key to the potential success. The proposal should be, amongst other things, simple and cost-effective. What we have now, unfortunately, is extremely complex, and it's also very difficult to evaluate the cost of the implementation of this proposal. We live in a world, in a tax world, of upheaval and questioning of old truths. The proposal is for the first time accepting the principle of taxation at destination or market instead of origin. So it's a revolutionary idea. But in the new digitalized world, I think we have to be innovative. Old rules might not be suitable unless they can be modified and adapted to current situations. So when we're talking unilateral measures and multilateral measures, in my view, the UN proposal is not a unilateral measure. What we are talking about there is a proposal to change a model for countries to negotiate bilaterally. And they could do that multilaterally as well. So it's not really what we're talking about in unilateral measures against multilateral taxation. What we're really dealing with is when countries introduce a digital service tax unilaterally in the domestic law. And that tax is an income tax. BEPS Action 1 proposed for countries that could not await the consensus-built Pillar 1 and Pillar 2 to introduce VAT digital services taxes. So that was the solution, given interim solution by the OECD for its members. What we are talking about and what is difficult is the digital service tax when it's an income tax applied unilaterally by one country. And why is it difficult? Well, first of all, there will be double taxation. It's an income tax. You're taxing a non-resident on income generated in your country. You're withholding a tax. That is probably not going to be given a credit for that tax in the other country. So you have generated double taxation. And secondly, perhaps the most important and difficult issue is that you're violating your tax treaties. You're violating your international agreements. So the Pandora's box is open. I actually think it was open perhaps some time ago when countries started to introduce unilateral measures like the UK. The UK, in accordance with its own government's acknowledgement, to my great surprise when I heard the Brexit discussion, actually referred to its own taxation rules here as breaking international agreements. So it's actually acknowledged by UK government that this tax actually is breaking international agreements. So will countries carry on unilateral measures? Well, I think, as I said, if the Pandora's box is open, the longer the multilateral solution takes, more countries will be tempted. So we just have to wait and see. Thank you, Anjana.
Thank you. And finally, I would like to welcome Brian J. Arnold for his presentation, please.
Thank you, Anjana. And I want to say what a pleasure it is to be on a panel with Carmel and Lisa. And I think we should all be very appreciative of the fact that it's the middle of the night in New Zealand. So Carmel, thank you very much for that. I want to spend my few minutes talking about Pillar 2. And as you know from what Pascal said, the blueprints for Pillar 1 and Pillar 2 were released by the OECD on Monday. I can tell you that the blueprint for Pillar 2 is 248 pages long. So it's going to be impossible for me to describe that proposal in detail in 5 minutes, but I think it's worthwhile to just get a bit of an overview of what is on the table. Now, as somebody said, Pillar 2 is designed to deal with base erosion and profit shifting problems that are left over from the BEPS project. It has been primarily driven by Germany, France, with the support of the United States, as long as the US GILTI rules are grandfathered. The work, however, has been carried out by the OECD Secretariat in the context of the inclusive framework, which of course is the body that is charged with implementing the BEPS project and has 137 members at present. The OECD, as Lisa has said, has come up with a very creative and comprehensive solution to these problems. The questions that I have are, is Pillar 2 fair to developing countries? And is it workable? Now, Pillar 2 consists of two major rules. There's a minimum tax, the global minimum tax. There's a supporting rule, which is the under-tax payments rule. And then there are two treaty changes. One is just the switchover clause for countries using the exemption method. And the last one is what you could refer to as a SOP to developing countries. It is a subject to tax rule. So let's look at the minimum tax just briefly. What the minimum tax does is it imposes a tax on the ultimate parent of a multinational group whose worldwide consolidated revenue exceeds 750 million euros. And that is the same threshold that applies for purposes of the country by country reporting measures. So the parent of a multinational group will pay tax to its country of residence on the difference between the foreign tax and the minimum tax rate on its foreign source income earned in a country through either PEs in that country or controlled foreign corporations in that country. And that difference between the minimum tax and the foreign tax is referred to as the top-up amount. They have not yet agreed on what the minimum rate will be, but the speculation is that 12.5% seems to be the best bet. Income for this purpose will be calculated in accordance with the accounting rules used by the ultimate parent corporation, with adjustments, comprehensive adjustments in terms of timing and permanent differences. And the foreign tax will be calculated on a country by country basis. If the ultimate parent company is resident in a country that decides not to apply the minimum tax, then the country in which the next highest subsidiary is resident will apply the minimum tax. Now, if we look at just briefly at the effects of the minimum tax itself, what you need to realize is that countries that decide to apply this minimum tax will basically have two corporate income taxes to deal with. So they'll have their regular domestic corporate income tax, and then sitting alongside it, they're going to have this special international global minimum tax. So the legislative and the administrative complexities involved in that are significant. With respect to source countries, the implications of the minimum tax are that if you don't tax currently at a rate equal to the minimum tax, then the residence country is going to take the tax on that income. And it basically means for source countries that their tax incentives will be effectively nullified by the minimum tax. Now, this is going to take us back into about 20 or 30 years ago when we were talking about tax-sparing provisions. This is much more important, however, because those tax-sparing provisions really only applied seriously to PEs, investment in another country through a PE, whereas this minimum tax is going to affect investment in a country through both PEs and CFCs. Now, the supporting rule is the undertax payments rule. I'm not going to say too much about it other than the fact that the minimum tax takes priority over the undertax payments rule. This basically says that if a country doesn't apply the minimum tax, so it only applies where the minimum tax doesn't apply, then the country in which payers of deductible amounts to low tax group members can impose tax on those payments up to the minimum rate. So the undertax payments rule, the way to think about it is that it is supportive of the minimum tax and it's inseparable from that minimum tax. So the same rules apply to calculate the top-up amount. However, the one thing I should say about the undertax payments rule, if, for example, the ultimate parent of a multinational enterprise is in a country that decides not to apply the minimum tax, then the undertax payments rule can apply to payments made from a source country to that country in which the ultimate parent is resident. The subject to tax rule is a standalone rule, so it applies whether or not the minimum tax or the undertax payments rule applies. And it basically says that a country in which a payer of interest, royalties, or payments for high tax services are made to a low taxed group entity in another country can impose tax on those payments to the extent that they are less than a minimum rate. Now, the minimum rate is not the same as the minimum rate for the global minimum tax. Because this is a payment on gross amounts, the minimum rate is probably going to be around 7%. So if the foreign tax is less than 7%, then the country in which the payer is resident can impose additional tax to make up that amount. Now, this is a treaty rule, so it's only beneficial to countries that have treaties that stop them from doing this. And it's only beneficial to the extent that these countries take the necessary action under their domestic law to impose tax on these payments. And it's going to require a multilateral mechanism like the multilateral legal instrument in order to implement these treaty changes. So I wish I could say at the end that what I've just said is all you need to know about Pillar 2. But we're tax people and we know that the devil's in the details, and there are a lot of devilish details in the 248 pages of that report. Thank you.
Thank you, Brian. Yes, 240 pages of that, and I think I was reading today that's about 780 pages of guidance just for the Tax Cuts and Jobs Act in the US. So if you multiply those two with all the other pieces of guidance, I'm sure it doesn't get any simpler. So we will start with our panel portion of this session, but before we do, I would like to ask all the attendees and invite you to share your questions and any comments you have. We'll be leaving 5 minutes at the end to hopefully respond to audience questions, so please do feel free to send them through. So in the interest of time, the first question I would like to put to you all is about the international tax rules proposed by the UN and the OECD. As we know, there are some differences between these two measures and the two proposals. So Lisa, what do you think the challenges are to ensure international tax rules are appropriate for both developing and developed countries in the years to come?
Well, Anjana, sorry, perhaps I would think that there are no such rules. I'm not too sure there are rules that are appropriate for both developing and developed countries, because basically they have different policy views. Well, I probably would say is that I think we are, tax treaties are negotiated, and you just have to try and build what is important for you. In our case, in Chile, we have tried to make our tax treaty network working for inward and outward investment more or less reciprocally. But that is an option, and that our country has taken. I think it would be try to convince a developed country perhaps that it's better to try and accept some rules from the UN model, giving the source country a little bit more taxing rights in that sense. I think that is probably a better way instead of trying to contribute to developing countries through their aid agencies. So in negotiations, I think the rules that you should try and go for is probably for a developed country in the UN model, and hopefully the developed countries can accept a little bit more of source taxation, accepting those rules. Thank you.
Thank you, Lisa. Can I ask Carmel, can I ask you the same question, please? Carmel, you're on mute, by the way.
I mean, it's quite natural that countries have, a self-interest in keeping their taxing rights, and there isn't any country that goes into a negotiation, be it a developing country or a developed country, that doesn't have that natural self-interest, and so they should. And most, and if you look to the models, the OECD and the UN model, the tax changes can, even at the margins, change the allocation of taxing rights. But they have to weigh up the benefit of concluding some kind of relationship, which doesn't just extend to the allocation of taxing rights, but also to a host of administrative agreements that make their administration work, to come to a position. But yeah, I think that's the balance that they need to strike. Yeah.
Thank you. And Brian, what about yourself? What are your thoughts?
Well, I agree with what Lisa and Carmel have both said, and I think that they will remember, and certainly we bear some of the scars of the debate, the strong opposition to the introduction of Article 12A of the UN Model Treaty, which gave some extended taxing rights over fees for technical services to developing countries. that was opposed vociferously by some of the members of the UN committee from developed countries who will remain unnamed. It was the US and the UK. That the only other thing that I would like to add is that I think it is just so important that we don't lose sight in this debate of moving to a revolutionary new tax system, just how much developing countries need technical assistance and capacity building assistance from other countries and from the international organizations. Their need is desperate, and their participation in the inclusive framework is meaningless without them having that technical assistance.
Yes, absolutely. And, you know, I think it's also mindful of the fact that developed and developing countries has completely different objectives. And even though developed economies could help developing economies, as you mentioned with Article 12A, we've been in a very similar scenario before. And it begs the question whether history may repeat itself. Brian, if I can stick with you, you spoke about Pillar 2 earlier. And naturally, that is the major talking point of the week, you know, Pillar 1, Pillar 2 blueprints. So I just wonder, what do you think works well and likewise still needs more consideration?
Well, as Pascal said, basically the work is done, and all that that needs doing now is getting political agreement on this. And I think the biggest concern that I have is the complexity of these rules. They are certainly not simple. And I mean, if you think about developing countries, think about a developing country that's currently a tax haven, or it taxes at 10%, which will be lower than. I mean, basically its choice is introduce a whole new tax system to make sure that you capture that revenue rather than it going to the developed residence country. So the fact that it works theoretically doesn't comfort me when I think about the needs of the least developing countries. So that's my my primary concern.
Mm-hmm. I've also heard from a few finance ministry officials that the political agreement is the easy part of this. It's the technical detail that's where the challenge is. Lisa, did you have any thoughts to add?
Well, I think the difficulty has been during this period is that the mix between getting the good guidance from policy people, what they want, to reach a technical solution. And I think, you're right, because, we were asked as technical, and Carmel and myself have been participating in this, of course, give us a technical solution. But in order to give you a technical solution, we need a political decision on what you want. So this has been the sort of chicken and egg situation, and we've sort of working with the steering group to get some guidance on what really wants. So I think the difficulty in the process is this, balance between when do you take a decision on what you want, and they only take that decision knowing technically if it's available. So I would say, and I should probably say that at this point, that I'm speaking in my personal capacity here. There's quite a lot of work to still be done, and I think things like this needs to mature and be worked over and over again. So I wouldn't sort of point out on anything specific, but I do think we have quite a lot of work to do still.
Thank you. Just a note to viewers, we only have just under 10 minutes left of this session. So if you do have any questions or comments, please do share them as quickly as you can, and we'll hopefully address them in the next few minutes. Until then, I would like to maybe just touch on the unilateralism points that have come up across the videos we heard earlier and from your presentations. And Carmel, I think you're quite well placed to maybe answer this first, considering New Zealand has an election around the corner and is also considering unilateral measures such as the digital services tax, as we've seen in many countries around the world. So why are countries growing impatient, and do you think these unilateral measures will be around for a number of years, especially because we're expecting, hopefully, some sort of agreement, political agreement by mid-2021?
Yeah, that's a really good question. I mean, obviously, there's a fiscal imperative. I mean, with both the GFC and which is now a little bit behind us, but also the COVID crisis, there's some imperative to raise revenue. I mean, there's a perception that over COVID, the tech firms have done very well because we've all had to get ourselves using technical mechanisms to connect. But I think beyond that, well beyond that, is that perceptions of unfairness, which I think most countries would experience. I mean, they do erode confidence in the international tax system, which in turn can undermine voluntary compliance with domestic law rules. So there's a concern that, everything might unravel if you don't tackle this issue. And governments and politicians face the issue of, well, are we going to get a multilateral solution? Because I think most reasonable politicians would prefer a multilateral solution, but at the same time, they face a reasonable amount of pressure, political pressure to do something. And then they may also see the idea if we say we're thinking of doing something that will motivate the multilateral organisations to push on and press ahead. I think that's the issues that they are confronted with.
Thanks. Lisa, what about yourself?
I can only agree, I think, with Carmel. Political pressure inside our countries is growing, and you just can't ignore that political pressure. And the longer this process is taking, the more the pressure will be on. So I think that I can only agree with what Carmel is saying. Thank you.
Brian, any thoughts?
Well, I don't have to speak for a government, so I guess I would say that I don't think there's anything wrong with reasonable unilateral actions. Okay. And I think that if you look around the world, a number of countries have introduced digital services taxes. And so that's, if a number of countries do it, then it ceases to be sort of unilateral. It's a unilateral action, but it's imitated, copied by a number of countries. It becomes sort of an accepted multilateral solution to a problem. And I think that's the real question. I mean, is a low rate digital services tax as a solution to this problem, especially on an interim basis, while we work towards this blueprint for a brave new world, is that better than what's on the table? I think that's one of the questions that should be confronted.
I think the key word there is definitely interim, whether this will be interim or whether there will be that overlap, which many companies that I've spoken to seem quite worried about. So I think that'll be an interesting one to watch. Can
I just respond to that by saying that the companies are concerned about double taxation? I understand that. However, if these taxes are kept at a low rate, the problem of double taxation, number one, is not nearly the same as when tax rates are like at 50%. And so it's just not as serious a problem. And there's nothing to stop, the international community getting together and negotiating so that these digital services taxes are creditable against the residence country tax. Why don't we work on that?
Yeah, very good point. Very conscious of time. We've only got a few minutes left and we are getting a few questions in, so we've got time hopefully just for one. So I'm just going to read this out. Are those OECD ideas for multilateral instrument require an update in accounting rules and or some kind of harmonized standards regarding accounting, tax base, tax incentives, and subsidies? I hope that was clear. So it's on the multilateral instrument and the updating required for accounting rules. I guess that's the clash between GAAP and all the others that we have. So does anyone feel comfortable in taking this question?
I don't feel comfortable in taking the question, but I will. I mean, I think that in Pillar 1, there will be there will have to be some kind of use of accounting standards to make the thresholds and the various rules that are going to apply work. And I think there's recognition of that in the blueprint.
Thanks. Any other comments on that? No? Okay, we have almost finished. We've got like a few seconds to finish up. So I'd like to thank all the panelists for their great views. I'm sure we could have talked for another half an hour at least on a few more topics to do with this and a few more conversations. I'd also like to thank the OECD, IMF, World Bank, and the UN for their contributions to this session, and of course Tax Co-op for this opportunity to have this conversation. So thank you everyone. I hope you enjoyed the session, and please do reach out to any of us on LinkedIn or throughout the event. Thank you.
Thanks, Anjana.
Thank you.
Bye.
Bye.